moved again so quickly so far. Okay, I'm placing an order to sell short Swiss franc. Price I'm looking 0.88365. Just right here. Okay.
Banks have come back and they seem to be expressing an interest, or they have expressed an interest in your debt then, Calin. How does that evolve, or how does the demand picture for your debt evolve when we're going to see further issuance from a new supranational player, if you like? The European Commission is going to be issuing on behalf of the EU, the Recovery Fund. That's what we're discussing here. How is your debt going to rub alongside their debt? How are they going to play together?
So what I see that global central banks look at is there more euro coming up? So in 2020, we saw 100 billion more issued in SSAs, so supranational, 270 billion issued more by European governments. So they didn't buy only relatively more, but they also in absolute terms bought more. So if you look at global central banks, they bought twice as much in European governments this year than they did in 2019. Now, for 2021, we expect a rise of issuance from the European Commission, as you mentioned, but also some of the European governments. So I actually expect this trend to continue. So the additional supply actually creates additional demand.
But what's the demand like on the long end? How hungry are investors for duration, Calin?
So if I look at central banks, they still have their sweet spot between 3 to 7 years. Some of them started buying a bit longer, beyond 10 years, but they don't like too long end issuances. On the long end, the demand remains mainly with insurance companies. Because of Solvency II, they try to match their asset and liability, so they're the largest group, and pension funds. But the long end is still popular because it gives you positive yield, which you don't get on the shorter end of the curve.
So we are going to see a lot of issuance from Europe to pay for all kinds of things to do with the pandemic and the recovery fund and all that green investment, Calin. That's going to be a theme of 2021 and beyond. You say that increased supply actually drives demand. Do you have conversations, though, with investors? Are there those out there that are nervous about whether it's going to, what all of this debt issuance is going to lead to in the end?
I heard only positive surprises. So yesterday I spoke to the Japanese investors. So I did a virtual roadshow to Tokyo, and they were extremely positive about Europe. They were really surprised that how fast we moved in this crisis compared to the previous crisis. We were slower to act. And they said that the more euro comes out, well, they will probably rebalance some of their portfolios from dollar to euro, which is positive for us as a European issuer.
I wonder how you think.
Okay, short position opened on Swiss franc and 0.88365.
Due to monetary policy, financing costs have actually gone down in certain parts of Europe and actually across the world, even in the US. So the repayment capacity to debt has become easier. And I see that trend continuing in 2021. We also have seen spreads tighten. For example, the Italy versus Bund spread is tighter than it was the beginning of last year. So I think 2021 will be, in that sense, quite easy for markets. And I'm quite optimistic about next year.
Okay, Calin, good to speak to you. Thanks very much for joining us once again. Calin Anavjansa, the European Stability Mechanism's CFO. Up next on the programme, Germany grapples with the coronavirus amid a steep surge in cases. We have that story for you next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. Right now, we are 42 minutes into the trading day, and we're looking at gains across European benchmark indexes. The DAX putting up the biggest gains, up more than 1%, even though Germany has recorded the most new coronavirus cases since the start of the pandemic. The news comes one day after the government imposed an even harder lockdown on Europe's largest economy. The Chancellor, Angela Merkel, warned that tough times lay ahead. Joining us now to talk more about that is Jörg Kramer. He is the chief economist at Commerzbank. Jörg, great to have you on the program. Really glad you could join us. I saw a note of yours, I think yesterday or the day before, where you said this harder lockdown could hit the economy, hit GDP by 4% a day. How concerned are you?
Well, I have no reason to change this statement because unlike before, not only restaurants and pubs are closed, but also all non-food retailers. And this makes a big difference. And therefore, my calculation is that on a daily basis, value added goes down by 4%. And we have to assume that the entire first quarter is affected by the lockdown. And therefore, my forecast is we are heading for a recession. That means negative growth, not only in the fourth quarter, but most likely also in the first quarter of next year. Therefore, a recession.
Jörg, you previously said that Germany urgently needs alternatives to mere closures. How are German businesses coping with selling online or pivoting to selling online? If you think about how that is doing as a theme versus other parts of Europe, is that going to be something that will show up in the economics?
Yeah, absolutely. That means that we have a lot of statistics showing that the consumers go online, but do not expect that this will prevent a recession in Germany. Also, the manufacturing sector, they are fine with Corona. They learned how to deal with Corona. But nevertheless, we have a hard lockdown. And from an analysis of GDP components, it's quite clear that we are likely to see a decline in GDP, despite the good performance of manufacturing, despite strong online activity in retail sales.
As you know, Jörg, I spent some years in Tübingen University. The biotech company CureVac is also based there, and the university city has had some innovative approaches to stopping the spread or slowing the spread of the coronavirus. Can Merkel learn lessons from Tübingen? Can the Bund learn lessons from Tübingen? Or is it more difficult to put these kinds of measures into effect on such a large scale?
Yeah, I think the government should learn from Tübingen, but I'm not sure whether they will do in the end, because the government tends to rely only on a strategy of a mere lockdown. But the city of Tübingen shows that there are alternatives. For example, widespread testing for the elderly, for example, regarding corona tests, or more effective Corona apps, for example, would also be a solution, or creating special shopping times for the elderly. That means there are a lot of other measures beyond a mere lockdown, but unfortunately the government has not learned a lot from Tübingen, I have to say. Therefore, I'm more pessimistic as the fourth quarter and the first quarter of this year is concerned.
As an economist, and looking as you do globally across Europe, Jörg, how do you look at governments' policies and projects to help parts of the economy? Some countries have taken a very sector-by-sector approach and said we'll support those sectors that have been most beaten up, and others have said we'll support any part of the economy. How do they compare from an economics perspective? How do those strategies rub up against each other?
Yeah, the strategy is not bad, because they all more or less rely on general support for those who are negatively affected. For example, in Germany, we made good experience with short-time working support. because this is good for all the companies negatively affected. But the downside of this strategy is this costs a lot of money, and the government debt to GDP ratios significantly move up. Even in Germany, we will go beyond 80% of GDP. And who will pay back all this debt? And this, of course, puts a lot of pressure on the ECB to continue to buy government bonds. You have to see, since the start of Corona, the net purchases of the ECB in terms of government bonds is roughly as high as the net issuance. It means the ECB entirely finances the budget deficits, and this is likely to continue next year. And this is very difficult, for the ECB to normalize this kind of policy, because due to the high costs to economically fight Corona.
I want to finally ask you, Jörg, about Brexit. There's a lot of talk about the effects a no deal would have on the UK economy, and of course, so many now are optimistic that we will reach a deal over the weekend. But I wonder how the German economy would be affected if no deal were reached. How difficult would it be for the German economy?
Well, first of all, one should not put all the blame on the UK in this discussion, I have to say, because the UK is an old democracy, and if they decide to leave, then this is not only an issue of the UK, but it also raises questions as far as the European Union is concerned. That having said, I have to say that the UK, together with France, China, and the US, they all roughly have 7–8% of our exports go to these countries. Therefore, the UK is important for Germany. And if there is a hard lockdown, this is not yet my main scenario, but in the case we get a hard Brexit, the UK is likely to impose, or will impose, then tariffs in line with the World Trade Organization. I think the majority of goods will be exempted from tariffs, but at least 60 or 40% or so of German exports to the UK will then be subject to tariffs. The tariffs may be in the area of a lower single. I think in the end this is negative, but I think this will not kill the exports of German exports to the UK. This is one negative factor, but not the total dominant one.
Okay, Jörg, thank you very much. Jörg Kramer, Commerzbank's chief economist. Thank you very much for joining us. Thanks for bringing us your thoughts. Up next on the programme, what opportunities come with the vaccine? We'll put that markets question to the Market Live team. Laura Cooper joins us next. This is Bloomberg.
Substantial further progress means what it says. It means we'll be looking for employment to be substantially closer to assessments of its maximum level and inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon that we're talking about here. Now, everyone knows how uncertain everyone's macroeconomic forecasts can be, and particularly in this sort of an environment. But nonetheless, it was quite an admission.
Any unwind of these programs, or even stopping them, leaves the Fed and the economy vulnerable. Specifically of concern is the corporate bond purchase program.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates. But that's really not the problem facing the economy right now. The level of interest rates is not holding the economy back.
Those were a series of guests talking about the central bank's decision, as well as the Fed chair himself, Jerome Powell, explaining it. European stocks are climbing this morning as authorities in Washington, outside of the Fed, are said to be looking at actually achieving a stimulus deal. Here on the continent, the European Union is talking about approving a vaccine before Christmas, potentially giving a boost to the region's battered economies. Joining us now is MLive's Laura Cooper to talk more about this. Laura, it seems to me that it hasn't been the virus at all, but the U.S. stimulus package really driving markets. Do you see that as the case here as well?
Well, that certainly does look to be the case, just the fact that we are seeing kind of this confluence of factors all coming together at once. So we have the potential for fiscal aid to finally be agreed upon. We have the Brexit deal potentially coming through. And we add in kind of central banks led by the Fed really giving the green light to risk assets to rally. That's really underpinning this positive tone that we're seeing. And that's despite kind of this ongoing virus containment challenges. But I think really markets are focused on that vaccine deployment, those positive 2021 prospects, and the fact that we are going to see these highly accommodative conditions persist through at least next year.
Laura, your thoughts on Bitcoin right now? There's been a lot of fuss about it getting over 22,000. I understand it's flirting with 23,000 as we speak, and we've seen some pretty high expectations from some parts of the institutional investments community. What do you think?
Well, it's quite interesting. Just the fact that we've seen Bitcoin surge only 20% this week is quite exceptional. So really whether this is kind of a question of speculative fervor that this is a bubble that could pop, or whether it has staying power, just given, the fact that ultimately we are seeing this broad debasement of fiat currencies, which has investors seeking real assets. So I think, yes, Bitcoin is quite volatile, but ultimately we are going to see this upward momentum likely be sustained because it is becoming more of a mainstream asset. We are seeing kind of this broadening investment base. So, whether it's 400,000, whether it's, a million, whether it's 30,000, I'm certainly not one to kind of put a point forecast on it, but I think ultimately momentum does indicate that it is going to go higher, even though we can't really necessarily kind of pin, fundamentals to any kind of valuation at this point.
All right, Laura, thanks very much. Laura Cooper there from the Bloomberg MLive team talking about Bitcoin as we watch it right now at $22,921, getting ever closer to 23,000. That's it for the European Open. Stay with Bloomberg Television. Up next, it's surveillance. Anna and I are headed off to radio, so maybe don't stay with Bloomberg Television. Maybe switch over and listen to us on London DAB Digital. This is Bloomberg.
Glass half full, Fed Chair Jay Powell sees the U.S. economy performing strongly in the second half of next year, but promises to keep supporting the economy. Decision day on Threadneedle Street, the Bank of England prepares for its final rate announcements of the year. Policymakers are set to keep stimulus unchanged, with the Brexit deal yet to materialize. And Bitcoin's rally, the cryptocurrency tops $20,000. Scott Minard says it could be worth $400,000. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacroix here in London. So let's get straight to the markets. A lot going on, of course, with Bitcoin. It was interesting to hear that conversation with Scarlett Fu and Tom Keene on Bitcoin. Mr. Minard saying that this is partly due to scarcity, that he sees it going up to as much as 400,000. I don't think it was a hard prediction, but he said that it could go up to that level, but also because of Fed policy, as he thinks they could start printing money. Now, European stocks are gaining on hope of a vaccine, the dollar slumping. We also look at some of the currencies that, of course, the U.S. labeled currency manipulators. And then overall, the pound actually climbing as officials cautiously predict a Brexit deal within days. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK and EU are heading for a final Brexit battle over fishing rights. It's a sign the two sides have largely settled their differences over the other major obstacles to a trade agreement. Officials are cautiously optimistic a deal could be reached within days, but are still warning large differences remain and talks could fall apart. Now, the EU is pushing to expedite the approval process for the COVID-19 vaccine from Pfizer and BioNTech. Sources tell Bloomberg the move could enable a rollout on the continent before Christmas. If the vaccine wins the backing of regulators on Monday, the Commission could sign off the same day, with the first jabs being shipped out on Wednesday. And European car sales have fallen 14% as countries have imposed new restrictions to stem the surge of coronavirus. Apart from a small gain back in September, sales have declined all year and are down 25% over the first 11 months. Electric cars could be one bright spot. Bloomberg Intelligence thinks they will exceed sales of diesel cars for the very first time this quarter. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, we're just getting some breaking news out of Norges Bank. Extremely interesting to see exactly what they're doing. Norges Bank holding its key rate at 0%. So the key rate is unchanged. Remember, we also have Bank of England later. We're not expecting much change for the Bank of England, as the governor, Andrew Bailey, has his last decision before 2021. 2021 is also Brexit Day. The only thing I would watch out for monetary policy, and it is monetary policy heavy today, is rumors or talk that the PBOC could go at it alone and start tightening, and that could actually change the trajectory for renminbi going forward. Now, the Fed staying the course on supporting the U.S. economy, promising to maintain its massive asset purchase program until it sees substantial progress in employment and inflation. Speaking after the central bank's last meeting of the year, the chair, the Fed chair, Jay Powell, sounded the most optimistic he's been since the coronavirus crisis actually began.
Substantial further progress means what it says. It means we'll be looking for employment to be substantially closer to assessments of its maximum level and inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon that we're talking about here. Now, everyone knows how uncertain everyone's macroeconomic forecasts can be, and particularly in this sort of an environment. But nonetheless, it was quite an admission.
Any unwind of these programs, or even stopping them, leaves the Fed and the economy vulnerable. Specifically of concern is the corporate bond purchase program.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates. But that's really not the problem facing the economy right now. The level of interest rates is not holding the economy back.
Meanwhile, on the fiscal front, congressional leaders are rushing to finalize the latest stimulus deal in time to attach it to a crucial government spending legislation, which they hope will pass by the end of the week. Well, joining us today to talk monetary policy is Paul Donovan. He's Global Chief Economist at UBS Wealth Management. Paul is also the author of the newly minted book, Profit and Prejudice, The Ludities of the Fourth Industrial Revolution, which came out earlier this year. And I have to say, Paul, is an absolute fantastic and important read. We'll get onto that in a second. But, Paul, when you look at some of the concerns out there and what we heard, of course, from the Fed chair yesterday, Jay Powell, it was a very difficult task that he was trying to do. Did he achieve the right balance in saying, we're here, we're supporting, but we're not doing anything yet because it'll get better?
Yes, I think by and large, he did get the right balance. I mean, the message from the Fed yesterday essentially was, we're going to continue to provide liquidity as long as the economy needs liquidity. And that's frankly all a central bank can do in this situation. As the Fed was also making clear, this is not a central bank problem. This is a fiscal problem. The US government took your money away from you, effectively, through locking down the economy. It's down to the US government to give it back. It's not down to the Federal Reserve. But I think the other very important point to take away, a lot of people have been worried that central banks are printing money, this will create inflation. Well, it doesn't create inflation. Printing too much money is what creates inflation. And implicit in Fed Chair Powell's remarks is acknowledgement that they won't print too much money, that they will be guided by the liquidity needs of the economy, and they will match those needs. And that, I think, is a very reassuring signal.
Paul, what kind of recovery are you expecting? So there are vaccines that are starting to be rolled out. Are we going to see a deep and sustained recovery as soon as we achieve herd immunity, and how quickly can we do that?
So I think we've got a fascinating situation from an economic point of view. I mean, this is a really exciting time because we're seeing a very unusual cyclical recovery for large parts of the economy, and very rapid cyclical recovery for parts of the economy. Then we've got sectors of the economy that need to wait for the vaccine. Travel, entertainment, leisure needs the vaccine in place to get normalization. And then we've got the accelerated structural changes of the economy, which in the long term are good, but create a lot of friction, a lot of distortions and problems in the short term. So we've got these three forces all coming together. I think the standard cyclical recovery is going to be very good. I think the vaccine is essential for a key part of the economy to get people back into airplanes and restaurants and so on and so forth. But then we're still going to be left with the sectors of the economy that are in, frankly, terminal decline as a result of structural change. And that's where the real policy challenge is going to be, particularly later next year, I think.
Paul, there's like a million questions on different stories that I need to ask you. So let's switch it up to, the Swiss franc, or the Swiss National Bank actually being labeled a currency manipulator. So what they've done so far has been actually blessed also by the IMF. Is there anything that they could have done not to get that label, and how problematic is that label for Switzerland?
So I think the issue here, of course, is that you've got this very, very rigid formula for assessing what is a currency manipulator. And it doesn't involve a great deal of economics, frankly. I mean, it's all fairly ridiculous stuff. So I don't think the SNB could have done anything. I mean, you can try and game the system, but if you're setting certain parameters which can't be moved, then certain circumstances will mean you can't avoid those parameters. The Swiss National Bank, of course, has been presiding over an appreciating Swiss franc. So it's not like they're dramatically reducing the value of the franc in order to gain huge competitive advantage against the United States. And frankly, I'm not sure that the United States should be quaking in its boots at the competitive challenge that an economy the size of Switzerland is offering. So I don't think that there's a great deal else that the SNB could have done in this situation. And I think we'll have to see what the incoming administration's approach is going to be. Of course, with former Fed Chair Yellen being nominated Treasury Secretary, we do have a proper economist coming in to run the Treasury. And her view may be perhaps a little more grounded in economic realism.
So are you expecting less of a hard line against Switzerland from Treasury under Biden?
I would be surprised if they were going to continue to be so aggressive. And of course, circumstances will change as we move out of the pandemic. The safe haven bid for the Swiss franc, I think, is likely to fade away. That will obviously be something which removes pressure from the SNB to intervene. You'll see shifts in demand patterns. The US trade position is likely to adjust as its own domestic production comes back from the current shutdowns. So there's lots of things that are going on here, which I think will change circumstances relatively quickly in the early part of next year.
Paul, thanks so much. Paul Donovan there from UBS Wealth Management. He stays with us, and we'll talk about Bank of England, we'll talk about PBOC, and I hope we also get to his book shortly. Coming up later this hour, we also speak with the Société Générale chairman. He's Lorenzo Binismaghi. We talk about the state of European banking and his outlook.
Ladies and gentlemen, I'm going to place stop on profit for Swiss franc at 0.88345. Just right here. Okay?
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Vladimir Putin there, Russia's president, in his annual end-of-year news conference, expected to last roughly 4 hours today. This is an annual event. You can see they're a bit more socially distanced, the reporters attending, and appropriately masked. Now, he will have the same format as most of his speaking engagements this year, which is a remote one due to the pandemic. So the president...
Position closed on Swiss franc, US dollar against Swiss franc. Got £200.
Joe Biden, the new administration, and maybe Russia's handling of the coronavirus, as new cases have surpassed, I believe, 25,000 a day. Now let's focus back also on central banks and the Bank of England, due to make its final policy decision of the year today. The central bank is expected to keep policy unchanged for now. Well, still with us, Paul Donovan from UBS Wealth Management. Paul, when you look at Brexit, what does it mean for the possibility of negative rates in the UK? So first of all, it's actually unclear whether we have a deal or not. How much damage or how much disruption will we see come January if there's no deal?
Well, I mean, we do think we will get to a deal. We're now at the stage where Prime Minister Johnson and President Macron are slapping each other around the face with wet fish. I mean, we're descending into farce, and I think it's unlikely that fish